But let's now welcome on board Vinit Sambre, Head Equities, DSP Mutual Fund, and ask him how to maneuver this market. Vinit, hi. Morning. Great to have you on the show. Vinit, good recovery at all indexes at a net level, perhaps from the March lows. But it seems like once again the litmus test has begun. Monsoon has been really subpar. You've got West Asia conflict, which is again sort of rising. Crude is back at $85 per barrel mark. And the market as well, it's getting very narrow as we speak right now. Very stock specific, very sector specific, around news flow kind of action is what we've been seeing off late. Do you sense this range bound move in the market is going to continue?
Yeah, good morning and thanks for having me on the show. So I believe that, as far as our markets are concerned, even if one looks at the earnings themselves have become very polarized. And I think markets are actually reacting to the polarization of earnings. And I believe till the time we see a broad-based kind of a earnings recovery taking place as far as the markets are concerned, I think this kind of select nature of the market should continue. And maybe today, more from let's say slightly medium to long term horizon, I believe that we are in a good consolidation phase as far as the markets overall are concerned. We have seen 2 years of earnings actually showing a single digit kind of a growth number, FY25 and FY26. So we are already on a low base. We've had so many of these geopolitical challenges. Now you're talking about monsoons. And through all of these, I think more important is that we have stayed resilient and there's a low base. So I believe that maybe over the course of next couple of quarters, as and when things sort of normalize, the geopolitical aspects also moderates. We know that crude oil price definitely will look low, and I think that should then maybe provide direction for the earnings growth and the market's direction as well. So I'm not quite negative with all the conflicts which are going on. We've been resilient. We have to look for places where the earnings maybe are inflecting or things are turning around. I think as of now, and maybe we wait some more time for the broad-based sort of a nature of the markets to pull up.
Vinit, hi. How do you look at IT companies' earnings so far? It's been pretty mixed, and there's no negative surprises except for Wipro, where the numbers have been weak.
No, I think you said it. I mean, generally, I have gone wrong on the IT. I've been slightly more, let's say, positive on the segment because of the fact that the valuations are sort of pricing in a lot of the risk which one is sort of talking about. And if one looks at the results till now, like you mentioned, I think what has happened is that, most of the companies are sort of calling out the large, big deflation risk is sort of behind them, and they are witnessing some bit of the challenges because of the AI and the stuff which is going around. But I think in midst of all these turmoil, the again I would say the segment results have been pretty okay. I would say resilient as of now. And maybe what could happen is that even in case of IT, I believe that there will be few companies which will emerge out well through this phase of AI deflation, and few companies who are not able to sort of move up or enhance their skill set, or see themselves benefiting from this AI trend. I think those will sort of move down. But overall, I feel that there's a maybe the sectors seems to have priced in a lot of the risk as of now. One can be selective in names where one believes that companies are moving ahead in the right direction in the current environment.
Vinit, one thing which is coming out from commentaries of corporates is while the focus is entirely on productivity gains from AI, companies are or Indian service providers are all now talking about the token cost which is going to come in, which will have an impact on the profitability of these companies who wants AI to be integrated. What is your view on that? Is productivity gains versus the token cost?
No, so I think we are still in the midst of a lot of transition out here, and as of now, we know that token costs are high, But there is also merit in understanding that eventually the token costs are going to go down as a lot of these capacities are going to get created. We know that so much of spends is taking place in the capacity creation globally, and that will eventually mean that the cost comes off, and that I think will lead to more enterprise-wide scaling up of AI, wherein our companies could see better volumes taking place. Today itself, we even in these results, we are seeing that the companies are calling out their revenues coming out from the AI, and pretty much companies are gearing up for sort of taking those into consideration. And these aspects around cost, I think the companies have sort of well understood and taken that into consideration. But that, as of now, when the costs are high, maybe that also means that there's a good combination of human and agents or AI, being placed in terms of the business. But eventually, as costs go down, that will only mean that the volumes of work will also inflate.
Okay, other than Wipro, of course, most of the IT names are still up in the green. But Vinit, tell me what's happening within the mid and small caps. Give us some interesting sectors that you're looking at.
See, I think overall, in the last 1 year, if we look at the trend, while Nifty has delivered single-digit growth in terms of the earnings, we've had the, let's say, BSE 200 or the broader markets doing even better, and that is actually reflected in the current market changes, wherein we have seen mid and small caps sort of doing well despite all the current geopolitical issues and the challenges. I would imagine that as far as the mid and small caps are concerned, again, there's a polarization. I would say there are a few sectors which sort of are sustaining a good growth, and amongst them would be, let's say, NBFCs, which are doing well, the capital markets play, which are doing well. We have hospitals within the broader healthcare, which have been sustaining decent growth, and I think that should sort of continue. Anything and everything to do with the whole power ecosystem, the capex spend, the data center, the whole EV transition. I think all of those ancillaries who are in those value chains are seeing sort of some of the other benefits. Post GST, we saw the auto sector actually showing strong volumes growth, and I mean, I continue and I was positive on the auto anchors on the back of their ability to be diversified and outgrow the auto OEs. While I continue my stance, I have seen the valuations have slightly gone or much ahead of their historical range, and maybe they are currently expensive. But still, in terms of the business momentum, I think that should continue for these. And the other important element is that most of the auto anchors are also diversifying into new areas like aircraft manufacturing, EMS, and all of that. So that should give them the edge to perform well. So I think overall, yeah, we have seen some of these categories do well. We still have maybe the consumer staples on the low end trying to recover from the lows. IT is still maybe not performing, so we'll have to wait and watch and maybe give them a couple of quarters before the volumes start increasing again. So I think broadly these are some of the sectors which we are looking at, and maybe one more trend to as an observation, I see that within healthcare, while hospitals are doing well, the domestic pharma market has also inflected. If one looks at the last 4 5 months of the IPM growth, they all of them are showing early teens kind of growth. So that itself may be talking of a recovery happening in the pharmaceutical sector as such.
Vinit, one sector which is seeing good tailwind is the banking sector with the kind of credit growth that we have seen 17-18% coming in there. In that sector, do you look at the mid-tier banks and the NBFCs where the delta would be much higher for them?
See, as a house, I think we prefer the large private sector banks and the large PSU banks as well, given the fact that the whole sector is maybe recovering, and more importantly, the asset quality is still in a very good shape and form, and the valuations are also pretty reasonable out there. So that's one category we like. Amongst or within the small and mid cap, I think I would prefer being in the NBFCs as such, because we see that they generally tend to have higher, growth in terms of the loan growth and in terms of the profitability growth, and also for uh, the NBFCs, the asset quality is also again going well for them. So from the mid cap perspective, I would prefer being in NBFCs as such, and the other maybe capital market place. But from the large cap, I think I would I'm positive on the large private sector banks.
Ah, okay. You were also positive. Hi, Vinny, this is Harsh also joining in. You were also positive real estate. There's been a very decent run up since. How are you positioned now? It's such a rotational market, right? The sector rotation and the churn is so high, which is not traditionally your philosophy. But talk to us about a little bit about real estate.
No, so I think if you observe in the last few years, what has happened is that while broader consumption trends have shown moderation, but we have seen premium end of the consumption actually doing well, and within that, real estate, jewelry, premium automobile sales, all of these are reflection of what's actually changing in the consumer mindset, and we sort of have to align with some of those. And you're right. Actually, the whole sector has gone through the bit of that high and low in terms of the valuation, and that actually depends a lot on the flows and sentiment. Maybe 1 or 2 months back, we had seen that the real estate sector valuations had come off, or the prices had come off for the large listed players. Whereas one looks at the pre-sale numbers, they are pretty much being quite resilient. And on top of that, for some of these companies, the kind of development work which is happening on the new capacity, that also will sort of come about and drive the demand growth going forward. So I believe that what we had in case of real estate is the fact that we had a pre-sales number being stable. We had the stock prices having seen correction, and maybe going forward, as the new development actually adds to the sales number, that should drive the sales momentum for the companies out there. So I think from the perspective that the real estate sector itself has consolidated now because of the RERA and all of that, and we have a lot of those regulatory checks and balances, maybe, and the companies are also pretty well organized companies. So it makes the sector maybe more sort of okay to sort of look at a low cycle of the valuations.
Okay. Vinit, thank you so much for joining us, giving us that perspective this morning. We'll let
Thank you
you
so
go.
much.
Thank you.